When most investors hear the word bonds, the image that comes to mind is safety, stability, and predictability. Bonds are often described as the boring part of a portfolio included to offset the excitement and volatility of stocks. That description is not entirely wrong, but it is dangerously incomplete. Bonds are not a single uniform asset class. They are a wide universe of instruments with different behaviors, risks, and strategic uses. Treating bonds as a simple ballast rather than a nuanced tool is one of the most common reasons investors misunderstand both their potential and their limitations. At the most basic level, a bond is a loan. You lend money to an issuer, and in return, you receive periodic interest payments and the return of principal at maturity. This simplicity hides several layers of complexity. Who you are lending to, how long you are lending, for what currency the bond is denominated in, and what protections exist if things go wrong all matter deeply. Bonds are shaped as much by interest rates, inflation, and credit conditions as stocks are shaped by growth and earnings. One way to move beyond the basics is to understand issuer types. Government bonds are often treated as risk-free, but that label depends on context. Bonds issued by stable governments in their own currency carry low default risk, yet they remain highly sensitive to interest rate changes and inflation. Corporate bonds introduce credit risk, which means the possibility that the issuer cannot meet its obligations. Within corporate bonds, there is a wide spectrum from investment-grade issuers with strong balance sheets to high-yield bonds that compensate investors for elevated default risk. These differences matter far more than the generic label bonds. Another critical dimension is maturity, often referred to as duration in practice. Short-term bonds are less sensitive to interest rate changes, but offer lower yields. Long-term bonds typically provide higher yields, but experience larger price swings when rates move. Duration is the bridge between bonds and volatility. Many investors are surprised to learn that long-duration bonds can be as volatile as equities in certain environments. Understanding duration is essential for using bonds strategically rather than reflexively. Inflation adds another layer. Traditional bonds pay fixed coupons, which means inflation erodes their real purchasing power over time. This risk becomes visible only after inflation has already done damage. Inflation-linked bonds attempt to address this by adjusting principal or payments with inflation measures. They do not eliminate risk, but they change its nature. Bonds are not automatically protective against inflation. They must be chosen with intention. Beyond plain vanilla bonds, there are specialized structures that serve distinct purposes. Floating rate bonds adjust interest payments as rates change, reducing sensitivity to rising rates. Municipal bonds offer tax advantages, but introduce geographic and fiscal risk. Mortgage-backed and asset-backed securities are tied to pools of loans, adding prepayment and structural complexity. Each of these instruments exists to solve a specific problem, and each introduces trade-offs that must be understood. Strategies matter just as much as instruments. Holding bonds to maturity emphasizes income and capital preservation. Trading bonds emphasizes price movement and rate expectations. Laddering bonds spreads maturity risk over time, reducing reinvestment uncertainty. Barbell strategies combine short and long-duration bonds to balance yield and flexibility. None of these approaches is inherently superior. Their effectiveness depends on objectives, time horizon, and tolerance for complexity. One of the most overlooked roles of bonds is behavioral. Bonds can stabilize portfolios during equity drawdowns, not just financially, but emotionally. That stability allows investors to maintain equity exposure when fear would otherwise force selling. However, this benefit only exists when bonds behave differently from stocks. Correlation matters. In some environments, bonds and stocks fall together, surprising investors who assumed diversification was automatic. Understanding when and why bonds provide diversification is critical. Bonds also interact with monetary policy more directly than most assets. Central bank actions influence yields curves and credit spreads. This makes bonds highly sensitive to macroeconomic regimes. A strategy that worked well in a falling rate world may fail in a rising rate one. Bonds demand contextual awareness. They reward those who understand the environment and punish those who assume the past will repeat automatically. The mistake many investors make is allocating to bonds by habit rather than by design. They choose a percentage because it sounds prudent, not because it matches a defined role. Bonds deserve the same level of intentionality as equities. They are not merely a defensive allocation. They are a toolkit for managing income risk and flexibility across different market conditions. As markets evolve and interest rate regimes shift, understanding bonds beyond the basics becomes increasingly important because the difference between bonds as a drag on performance and bonds as a strategic advantage lies in knowing which types to use, how to structure them, and what role they are meant to play. And that brings us directly to the next part, where we need to examine how bonds can be used deliberately rather than defensively, because the real value of bonds emerges only when their role is clearly defined. Bonds add strength to a portfolio when they are selected to solve specific problems, stabilizing cash flow, reducing drawdowns, managing interest rate exposure, or providing dry powder during equity stress. When bonds are chosen simply because they are safer, they often disappoint. Safety without context is an assumption, not a strategy. One effective way to think about bonds is to separate income bonds from stability bonds. Income-oriented bonds focus on yield and cash flow, often through corporate credit high-yield bonds or longer maturities. They can enhance portfolio income, but introduce credit and duration risk that behaves more like equity during downturns. Stability-oriented bonds, typically high-quality government bonds or short-duration instruments, aim to preserve capital and offset equity volatility. Mixing these two roles without recognizing their differences is a common source of confusion. A bond that boosts income is rarely the same bond that protects you in a crisis. Duration management is where strategy becomes concrete. In rising rate environments, long-duration bonds suffer, while short-duration bonds preserve flexibility. In falling rate or recessionary environments, longer-duration bonds often provide strong diversification benefits. There is no permanently correct duration. There is only duration that matches your objective and environment. Laddering maturities reduces the need to predict rates by spreading reinvestment across time. Barbell strategies offer flexibility by combining safety and opportunity. These are not forecasts. They are structural choices. Credit strategy is equally important. Investment-grade bonds prioritize reliability. High-yield bonds prioritize compensation for risk. Mixing them without understanding correlation can undermine diversification. During economic stress, credit spreads widen and high-yield bonds often fall alongside equities. Investors who rely on credit-heavy bond allocations for protection discover too late that they built income, not insurance. Bonds must earn their place by behavior, not label. Inflation-aware strategies deserve attention as well. Fixed-income investors lose silently when inflation erodes purchasing power. Inflation-linked bonds, floating-rate notes, and short-duration instruments help address this risk, but each comes with trade-offs. Inflation protection is not free. It is purchased through lower yields or structural complexity. The strategic question is not how to eliminate inflation risk, but how much of it you are willing to carry knowingly. Perhaps the most underappreciated bond strategy is using bonds as optional capital. High-quality liquid bonds can be reallocated during equity drawdowns, effectively converting stability into opportunity. This rebalancing role transforms bonds from passive holdings into active contributors to long-term returns. But this only works if bonds are truly liquid and uncorrelated at the moment they are needed. Planning this in advance is essential. The final lesson is behavioral. Bonds are not exciting, and that is their advantage. They slow portfolios down. They give investors time to think. They reduce the odds of panic-driven decisions. When bonds are aligned with purpose, they support discipline. When they are misunderstood, they become a source of frustration and misplaced expectations. In the end, bonds beyond the basics are not about complexity for its own sake. They are about intention. Knowing why each bond exists in the portfolio, how it is expected to behave, and what trade-offs it introduces, turns bonds from a background allocation into a strategic asset. That clarity is what allows bonds to contribute, not just to returns, but to survival and consistency across cycles. If this discussion changed how you think about bonds, consider subscribing to stay with these deeper conversations that focus on structure rather than slogans, and leave a comment sharing which role you currently expect bonds to play in your portfolio. Because clarity about that role is often the first step toward using them effectively.